So thank you for coming to this. This is a somewhat unusual topic for a technical conference like SQL Saturday. I was thrilled that the organizers chose me to give it despite that. I think it's something that all developers would benefit from knowing more about, which is why I am inspired to do it, especially database developers, but probably any developer. So if you don't know a T account from a T-bone and you want to, this is the session for you. Now, if we were at Microsoft's current headquarters for SQL Saturday, just because I'm also interested in New York City history, this is the building that used to be on that site at 8th and 42nd from the 20s through the early 70s, the Franklin Savings Bank. Somehow I just find that fascinating. Anyway, for those of you who don't know me, I'm Mark Frawley. I'm a BI architect from Tallan, based in New York City. I've worked on all aspects of data warehousing and BI design and development for 20 years. I coincidentally wrote the data warehousing chapter of the Microsoft Press book, Programming SQL Server 2008. So, I have to do a little bit of a Tallan sales pitch, so here it goes. This shows you interesting things about us. We've been around a long time. We've done a huge number of projects for a huge number of clients. We've got 5 gold partnerships and a very wide range of experience and a decent geographic presence too. The company's actually headquartered in Rocky Hill, Connecticut, but we do have a New York office, which I'm based out of. Here are some of our long-term partnerships, which is pretty impressive. These are our practice areas, many of the key parts of Microsoft and where it's going these days. I'll say a little more about the BI practice since I'm in it. Prudential and Moran Towing are 2 of my most recent clients, especially Moran had a direct bearing on interfacing to accounting and contributed to inspiring me to do this. Our BI practice does all the usual things that you would expect from a Microsoft BI stack BI practice. We pretty much can do anything that falls in that realm. So before I go to goals, here are non-goals. This is not a tech-heavy, demo-heavy presentation like most of the ones would be here, or even most tech talks would be by its very nature. In fact, it's one of the main points of this subject is that it's not technical, at least not in that sense, and that's a good thing. That is a motivation for learning about it, in my opinion, which I hope to convince you of. I don't have an agenda as such. I started out trying to, but found that the material just didn't seem to want to fall into an agenda-like linear sequential kind of a thing, because it's more like a spiral where you go around and keep coming back to certain things and filling in more blanks after you've laid some groundwork. So best I could do is explain what my goals are. First one is what this topic is and why, as a developer, you should care, why it's worth learning about. I explained that what I see as a difference between accounting and bookkeeping, which many people think of as synonymous, but I think they're not exactly. Not everyone might agree with that, but that's my position. Then I'm going to review all the fundamental terms and concepts that are involved in bookkeeping that you are most likely to encounter as a developer who has to either consume or emit accounting/bookkeeping like data. Originally, since this can't be in 1 hour a course about bookkeeping or anything like that, I was going to not even attempt to take a bigger context picture and I was just going to go through the terms you're most likely to hear and what they mean, so that at least you'd know you'd heard of them before, and that was about it. But I kept finding that it just was impossible to say anything that was intelligible about any of this stuff without a larger context. And so I wanted to avoid having to go to the accounting equation and talking about assets and liabilities and stuff, but there's just no way to explain this or to explain how debits and credits work and that kind of thing without going to that level. At least I couldn't see anyway. So we're going to have to slog through some of that stuff. And it may not be the most scintillating, and I apologize, but sometimes you just have to go back to basics, and there's no way to avoid it. Then, hopefully a little more interesting with that background, I'll highlight a few things I've seen over the years in accounting slash BI reporting types of applications, things that happen, things people do not necessarily well advisedly because they don't necessarily understand this stuff. And I can give you some heads up for possibly recognizing when you might be seeing that in an existing application and maybe avoid it or be more thoughtful about it, I guess you might say, if you're building a new application. And then finally, just a little teeny bit of tech in showing how analysis services directly in a cubes can support some bookkeeping concepts. Really, it's just the aggregation of the chart of accounts is really what it is, which will make more sense to you when we get to that. So, what is it and who cares? Why should you care? Well, I've got a whole bunch of reasons. I don't want to belabor the point, but this is one of my most substantive slides, I guess you could say. First of all, it's very common for financial reporting BI projects to source from the accounting record keeping system. So it's good to know something about what that means. The terminology and concepts of accounting, in my opinion, tend to be unintuitive to non-specialists like most of us developers who have not had any particular training in accounting or bookkeeping and may even have liked it that way. And what's worse, because of some common misconceptions about things like whether a credit means positive or negative or increase or decrease, you may think you understand some of this stuff more than you really do, just because there are some common misconceptions, and that might be worse than plainly not knowing anything at all. I have a quick story to tell that motivated my interest in this topic. A long time ago at a prior job when I worked for a French investment bank in their US subsidiary, I was deeply involved back in the mid-90s helping them design and build their first data warehouse. And there was this guy named Phil on the project, a VP, whose background was in accounting, not IT, but he was very smart and taught himself IT. And in fact, he wrote most of the applications that were there at the time in DAX Basic, believe it or not. And he also understood the commercial banking products that we dealt with in the branch. And because of this dual background and the ability to bridge both of them, this guy was just the rock star of the project. And the bottleneck, of course. He had to be in every meeting, involved in every decision. He was the only person you could say that about on a rather large project team. And he got commensurate influence and respect and frankly job security because of that. And I witnessed that and thought, I'd like a little of that too. So I set out to try to educate myself more about these things so that I wouldn't feel like it was a foreign language. Now, if those aren't enough reasons, here are some more that might be even more developer interesting. The principles of this have literally not changed essentially in literally centuries since the 1500s or even 1400s, depending on whose history you take. So contrary to any technology you might choose to learn, this has an infinite half-life, essentially. You learn this once, and you're good to go for the rest of your career. Furthermore, unlike any tech you might learn or any vertical industry you might learn about, these principles apply across the board to any kind of enterprise, regardless of its size, its industry, whether it's profit or nonprofit, private or governmental. Basically, I can't think of a single work-related topic you could learn about that is as broadly applicable to no matter what you find yourself doing and won't change, so that you're not on that treadmill. Knowing this will improve your understanding, obviously, and of requirements and your ability to communicate directly with the business and not be dependent on BAs and other intermediaries who may introduce misunderstandings or aren't available. And that makes you more versatile and valuable, too. I like to say that everyone who knows anyone who's been abroad to a non-English speaking country usually comes back and says that if you just try to speak the language, however badly, you get treated a lot better and get a lot more respect. Well, I think that's true with developers in business speak also. Another reason is I think knowing about this stuff is an antidote to having your work offshored, because if you know tech and this material, that is far more unlikely. The most of the tech type jobs that get offshored are the ones, at least in what I've observed, that where it's just pure tech, and they don't have any particular domain knowledge or business knowledge or need to be in front of the business or work with the business. So this is an antidote to that, and I think improves job security. And then finally, there's personal benefits. You can evaluate an annual report of investment you're considering. You might find yourself on the board of a charity that issues an annual report that you need to understand more about. I personally have found it extremely valuable living in a cooperative apartment building, which is a corporation, and I was on the board for many years and even personally constructed the accounting statements for some time until we got an accountant. It's just been very valuable. And finally, I used to hear business people say pretty often, I think it's less true now, but that it was far easier supposedly to teach a business person tech than it was to teach a tech person business. And every time I heard that, it really annoyed me and made me want to put the lie to that. So you can do that too by learning more about this. So we'll plunge right in. What is accounting? I can't do better than Wikipedia's definition, which is that it's the measurement, processing, and communication of financial information about economic entities. Okay, great. What's an economic entity? Well, it's any entity that can engage in financial activities, which includes all of us as individuals, businesses, all levels of government, nonprofits, pretty much anything that can be recognized as an entity and can engage in financial activity is a economic entity. We'll focus on businesses because the accounting perspective on each of these categories is slightly different, but mostly it's the same, but I'll focus on business. So accounting is where it's decided how to characterize and record financial transactions at a relatively higher level, such things as when are we going to recognize revenue in terms relative to when we actually receive the cash. Not that there aren't standards, there's GAAP, generally accepted accounting principles, but there's also a large amount of discretion and gray areas when operating at this level, which unfortunately means there's a lot of potential for manipulating things and not necessarily representing things as accurately as one might hope, but that's just in the nature of the subject. There's some key assumptions accountancy makes about businesses, three of which I'll mention. That they don't really concern us after this, but they're so important that they're worth mentioning. One is that a business and its owners, usually called shareholders, are distinct economic entities, which is very important so that you can do accounting on the interaction between the owners and the business and keep them separate. That distinction is made even if it's a sole proprietorship, even though from an accounting point of view, even though legally the business and the person owner are seen as the same thing. Another is that the business is a going concern, meaning that it's viable for the foreseeable future, able to meet its obligations, not in danger of being about to go bankrupt or be liquidated. That's very important, because if that is not a good assumption, then everything else pretty much is out the window about accounting wise for what's going on. And finally, it's assumed that we deal with activities that can be measured in money terms. There's all sorts of activities and events and transactions that can't be measured that way, either because they're not of that nature or they're so intangible that you can't really do it. And for the most part, accounting is not concerned with those things. So why do we do accounting? It's to provide third parties with the information that they need to make decisions with respect to the business. These third parties may be internal or external. Internal, of course, includes finance and HR and senior management who wants to know what the state of the business is and how it relates to budgets and goals. There's far more external third parties, which include actual and potential investors and creditors, auditors, regulators, the IRS, other tax authorities, even sometimes customers who don't want to deal with you unless they see you as stable and solvent. So accounting plus bookkeeping culminates with the periodic preparation of financial records. Periodic is important. I'll talk more about that. And the financial records are these things that everyone has probably heard of, and you see them in an annual report. For instance, the balance sheet, the income statement, and the statement of cash flows. I'll mostly be talking about the balance sheet, and a little bit about the income statement, and not at all about the cash flow statement. And I can only stress over and over that this is not you're not going to learn to do bookkeeping here. We're not going to go through how to debit and credit different accounts for a given kind of transaction. There's no time for anything like that. Just let this wash over you, and then hopefully you'll have enough background and inspiration to look into it more if you want to. I just wanted to point out, since this is all about, accounting is all about numbers, most of us tend to give numbers more respect than they may deserve. So always keep in mind when dealing with accounting that just because you've reduced something to a number in an account doesn't necessarily mean it has a lot of credibility or precision. And it's worth pointing out that even the best financial reporting doesn't reveal everything that's important. It says nothing about management quality, about strategy, about competitors, about a whole host of other things. So even in terms of evaluating an investment or something, being able to read the financial statements is great, but there's far more that's also important, and that's why annual reports are so thick. Now, bookkeeping, which I am making a distinction about, which again, and not everyone might agree with, is they're related but not the same. I see accounting as properly so called as operating at a more abstract principle level, kind of more the level of, being a profession where you're concerned with the forest. And of course it has implications for the trees, but most of what's really worthwhile is at the forest level, including developing what those standards should be, refining them, arguing about where those discretion exists legitimately. And there's good arguments on many sides for doing things in various ways. That's the province of accounting, properly named as I see it. Whereas bookkeeping is really the record keeping that results from accounting decisions and dictates. And by its very nature, it's very rote and mechanistic and has relatively little discretion. And that's why it was one of the first business applications to be computerized, because it fit that role perfectly. But the most important thing for us as developers is that if you do have to interface to this kind of stuff, it's almost certainly going to be a bookkeeping type system, not something to do with accounting. Document management and portals to corporate information and that kind of thing is probably more where you might see things at the accounting level. But if you're bringing data into a database and doing reports on it and stuff, it's almost certainly going to be bookkeeping data. So it's worth seeing things in that way, I think. So we'll start at the top and work down. As I said earlier, I hoped to avoid having to do this, but there's just no way to give enough context and also avoid digging into some of this stuff, some of these fundamentals. So we're just going to have to do it. The starting point really for bookkeeping / accounting is what's called the accounting equation, the components of which are assets, liabilities, and equity. And I think at least the first two, most of us have a reasonable sense of what they mean from personal life. Assets are things that you own or are owed to you. Liabilities are things that you owe somebody else. Equity is probably least maps to personal experience, but it's essentially what people call net worth, which you have to calculate when you go to get a mortgage or something, mainly, I suppose. It's basically what's left after you subtract liabilities from assets, if anything. And it's also known as shareholders' equity, owner's equity, capital, book value, or liquidation value. All of these pretty much mean the same thing. What would be left after all the obligations are paid off? So obviously, if that number is negative, the entity is or soon will be bankrupt if something isn't done about it. So management does not want to see equity going down, much less going negative. So here's the accounting equation. Assets equal liabilities plus equity. The fundamental thing other than the equation is that as activity is recorded against these categories, this equation must remain in balance. If not at every point in time, at least at the points in time that you're going to do financial reporting from it. So knowing that and looking at the equation, it's tempting to see the equity term as a fudge factor that you simply adjust as necessary to make the equation balanced. It's not that simple, naturally. And it's also true that the assets and the liabilities can be fudged or otherwise discretionarily measured just as much in order to come out with a preconceived result. And that's just one of the things one has to keep in mind when looking at accounting, especially for something you're thinking of investing in. So as I said, it applies at a point in time at least, which is typically monthly, quarterly, and annually. So with that, we can now get into accounts. We all know about accounts from our checking account and our retirement statements. Those are accounts. I think we all kind of have a good idea of an account. Accounts usually have names and usually account numbers. They have types, which is something we don't think about so much personally, but an account is characterized among many things by what its type is in terms of the accounting equation. So if an account is either an asset account, a liability account, an equity account, and there's certain derived other kinds of accounts, mainly about income and expense, which we'll get to. But that's a fundamental characteristic of an account, is its type from an accounting point of view. And that's extremely important because that determines its behavior in terms of debits and credits and what means more, what means less, etc., as we will see. So debits and credits. We all think we have a sense of what this means, or we don't think, we know we have a sense of what it means, that we derive probably from our checking account or our checkbook mainly, that, where there's a single running total and you add entries and subtract entries as you make deposits and withdrawals. And so we tend to associate a credit with a deposit and a debit with a withdrawal. And from this, we kind of tend to get the positive connotation and a positive sign that credits involve positive and debits are negative because you subtract. And I think that's a big source of the kind of confusion or misunderstanding, or gets in the way of understanding the larger topic, because it's not that isn't in fact the case sometimes in accounting, bookkeeping. It's just that it's not always the case. And if you don't understand when it is and when it's the opposite of that, you can't understand anything. So that's why I'm stressing this. And that's probably the most important takeaway. So in bookkeeping entries, all entries against an account are positive. You don't put pluses and minuses like you do in a checkbook. All entries are positive, usually. There are pathological cases possibly where they might literally be negative, but instead of a sign, the notion of an increase or a decrease is what's expressed through debits and credits. But you have to remember that what constitutes an increase or a decrease, and therefore a debit or a credit, depends on the type of an account. Debits and credits sometimes mean increases and sometimes mean decreases on each side. It depends on the type of the account. And it's just convention. It's long-standing convention, and it might seem arbitrary, but it is what it is. And just like you have to accept the arbitrary constructs in whatever programming language you're using, and most of us don't have much trouble doing that, because let's face it, those things are filled with arbitrary conventions. It's the same thing here. So if you're a good developer, you can learn this stuff too, I think. Here's a graphic of an account. It's called a T account for the fairly obvious reason. These things used to literally exist on paper in ledger books. Now this is more of a conceptual kind of a thing with everything in a computer, but it's still very useful to understand. So here's a T account representation of an account called cash. The name is at the top and the account number if it has one. And you see it's divided into two columns that are labeled the debit side and the credit side. In bookkeeping, that's all debit and credit means. It means the left side and the right side of a T account. And it doesn't change, unlike what means increase or decrease, which does change on the account type. The sidedness does not change regardless of the account type. Left side is always debit and right side is always credit. So when you hit accounts in this kind of a representation, you write a number on one side or the other, and that's called debiting it or crediting it. But what that actually means depends on the kind of an account. The assets, liabilities, and equity, of course, all break down into multiple accounts, many accounts, to keep track of things at a finer grain, as we will see. Don't try to memorize this complicated picture, but this gives you the big picture on what I'm talking about here. At the top, we see the accounting equation and represented as T accounts at that high level. And as you can see, you see in each case which side, debit or credit, represents an increase and which side represents a decrease. I like to say that immediately we can see some unintuitive stuff here, because look on the asset side where we see that a debit means an increase. Well, assets going up is good. cash is an asset, a new building is an asset, and when you acquire those, your assets increase. But how do you account for that in the asset account? You debit it. You don't credit it the way you might have thought. Similarly, with liabilities, you would think that since liabilities are in some sense bad or undesirable, you might kind of think that crediting them meant a reduction, but it doesn't. It means an increase. There's nothing more or less to say. These are conventions and they've been worked out, and you can basically see that the sense is opposite depending on which side of the equation you're on. The NB on each one means normal balance, and what that's trying to express is that that side, which you'll notice is always the increase side, is the normal balance. Normal balance means that for that type of account, when you subtract the debits or the credits, the balance of the account will be on that side. So in other words, the natural state of an asset account is to be a debit balance, meaning that there's a greater amount of debits than credits. And that makes sense when you think about it. If it's a growing business, you would expect the asset account to grow over time as you acquire more and more buildings and cash in the bank and whatever. Your assets are increasing. So the normal balance on that type of account should be the increased type of account, which happens to be the debit side. That's the normal balance. That's good to know so that when you just are looking at them, you know whether something is abnormal or not. For instance, on the asset side, if you had a credit balance, it wouldn't be good. It would mean that basically you not only had no assets net, but that you were in debt in some sense, or it could mean that. And then I show a breakdown of the equity side, which is probably the least understood and least appreciated of these three things, into its components, which we're not going to much go into here because that's where you're really getting into bookkeeping and accounting, and we just don't have time for that. But the equity is made up of common stock minus dividends paid plus revenues minus expenses. Revenues and expenses are probably of most interest, and we'll cover them somewhat more. Now, when you look at this, in the aggregate, the sum of debits and credits across all the accounts has to equal. That's the form of that equation holding. This brings us to the general ledger, otherwise known as the GL, which is nothing more than the set of all accounts that have been set up to track entity financial activity. It's a physical realization of that. Used to be in ledgers, now it's in the computer most of the time. The set of all those accounts and their hierarchical relationship, which we haven't quite gotten to yet, is called the chart of accounts. So you'll hear these terms all the time. As I've said before, the three elements of the accounting equation are usually divided, or not usually, always are divided into multiple detailed accounts, which suggests the idea of hierarchies and aggregation, and we'll see that with analysis services. So here's a representative balance sheet that I stole from the internet for a small business. And you see the three main categories. You'll see this on any balance sheet. In any annual report, we'll have these three categories. And at the bottom, it will show how total assets equals total liabilities and owner's equity as per the equation. And you can see a couple of other interesting things that we're not going to go into at all, but that for instance, that a distinction is made between current assets and liabilities and long-term ones, which is simply defined as less than or more than a year's relevance. That's a worthwhile breakdown, obviously, because you what's going on in the short term may depend on whether you have enough cash to meet payroll and stuff. You might be looking good in a longer term, but if you run out of cash in the future, you're going to be in trouble anyway. So that's why they make that distinction. Can't not mention double entry bookkeeping. That is simply a methodology that's used in bookkeeping wherein when you're going to hit an account to account for a transaction, you never hit just one account. You always have to hit at least two accounts. At least one account is going to be debited and at least one is going to be credited every time you make an entry. Sometimes you can debit or credit multiple accounts on one or the other side, or even both sides. It doesn't have to be one and one, but it does have to be that there's two sides to it. One or more get debited and one or more get credited, always. So you can't really know how to do that or which accounts should be hit in what way without understanding the bookkeeping principles so that you know how to characterize a given transaction in terms of which accounts does it affect and in which way, given what the transaction is. And that is what bookkeepers know how to do with guidance from accounting. So here's a quick quiz. Does that observation imply that one side always increases and the other side always decreases? That is another kind of intuitive feeling we would have from knowing that debits and credits sort of are opposite in some sense. Well, of course, the answer is no, because whether an increase or decrease happens depends on the account type as well as whether it's a debit or credit. So it's quite possible that you will credit one type of account and debit another one, and that even though it's debit and credit, that might mean increase in both of the accounts, or it might mean decrease in both of them, or it might mean increase in one and decrease in the other. It all depends on the type of transaction. Again, that's pretty unintuitive for most of us. Why do we do it? Well, it's simply a methodology, a mechanical methodology to know that the bookkeeping has been done as correctly as a mechanical methodology can achieve anyway. Since the debits and credits are supposed to equal across the aggregate if you've done your bookkeeping correctly, if they don't, you know that something is amiss that you have to track down and fix. It's as simple as that. Now, of course, not all errors can be caught this way. If you don't record a transaction at all, or if you record it twice, or any number of other permutations, there's no way that simple double entry bookkeeping can catch those things. And that's why there's auditors. But can't talk about this without mentioning double entry bookkeeping. Okay, now it's time to get a focus on time because, and I hope you're starting to see how you just kind of go around and around, and some of these concepts just don't make any sense until you've got certain other backgrounds. So now it's time to bring the idea of accounting period in, and then we can say even more about accounts. Accounting is always with respect to time, as is the derived financial reporting. The balance sheet is as of a point in time, which typically the end of the period, the so-called accounting period, which typically would be quarter end or year end or maybe month end. And it is derives from the balance sheet accounts. The income statement, that second financial report, is for a defined period, typically monthly, quarterly, or annually, and it derives from the income expense accounts that we saw in that earlier graphic. Period implies the start and end dates, and thus opening and closing balances. Those are important terms that you'll certainly hear. At the start of an accounting period, balance sheet accounts have an opening balance, which is nothing more than their closing balance in the prior accounting period. They're called permanent accounts because basically once opened, they have a balance that persists across time forever. This doesn't have to do with whether the balance happens to be zero, but more the idea that it's tracking the additions and subtractions, or really the debits and credits to it for all time. It's like a running total from the start of the business, or at least the start of when that account was opened. And so these are called permanent, and that's their nature. So when you start a new accounting period, these types of accounts, you have to record what's the opening balance, because it's with respect to that this period's activity will happen. Income expense accounts are treated differently and are named differently. They're called temporary or nominal accounts. That's because the way they're made to behave is they're not considered balance sheet accounts. That's why in that graphic you saw them sort of derived down below under shareholder equity. But it's been found that this is a convenient way to record things that typically have high cardinality, like, income means every time you make a sale, and expense means every time you incur an expense or a bill. These things happen usually with very high frequency compared to the kinds of things that are recorded on the balance sheet, and it makes sense therefore to record them separately and just treat the aggregate effect of them. And that's what's done. And the way it's done is that those kind of accounts start out set to zero at the start of an accounting period. And then you debit and credit them throughout the period, and you end up with a balance in them at the end of the period. but you don't leave that balance in them. You transfer the net of them to some balance sheet account, which you saw in the other graphic flowing up to shareholders' equity, essentially, one way or another. And then you zero them out for the start of the next period. So because of that behavior, they're called nominal or temporary. Now, we can't avoid the accounting cycle because this is, if you're interfacing with an accounting system or application, this is crucial to what's going on, to when you can get the data, when the data is in an appropriate state to get, a whole bunch of things. There's just no avoiding it. So we'll go through it very quickly in a minimum of detail. The first thing that has to happen is that each transaction has to be analyzed somehow, either by the system or by a person, to determine its nature, whether it even is something that should be recorded in accounting, and if so, in what way, which accounts, and in which way should they be debited and credited. Having determined that, you don't just directly make entries to the GL, typically. Instead, there's a separate representation that's usually called a journal. It's sort of like those T accounts where you record chronologically the date of the transaction and some details about it, so that if there's some error, you can trace back to the original source documents of that transaction to figure out what's going on. That kind of detail is irrelevant to the GL, but it's relevant to making sure everything's going correctly. So that's called a journal, and you write your debits and credits to the various accounts there as they happen with the date, using double entry bookkeeping. And then at the end of the accounting period, you total all those journals up, or net them out, as you might say, and you post the net credit or debit balance of each of them to a corresponding actual GL account, which had an opening balance, and you post the net of the changes during the period, and then you end up with a closing balance, is essentially what that is. And again, this is mostly automated today, but it can be manual in a small business. Then you prepare the trial balance. This is a key term you'll hear. If you are around accountants and bookkeepers in any company, you'll hear the term trial balance all the time, and the accounting cycle all the time. That's why I'm stressing it. So here's where you test the equality of the debits and credits. That is the trial balance. And if you find that they don't equal, then you know something's wrong and you have to go back and deal with it. That something wrong could be anything from errors were made in the debiting and crediting that you have to track down, or, and this is where it gets into accounting, there can be conceptually reasons that adjustments should be made to these numbers by additional entries that have not yet happened but are part of this trial balance procedure to bring them into balance. And they're not fudge factors, they're just accounting for things that should be accounted for but aren't otherwise accounted for in the normal transactional way of doing things. So that is far beyond our scope here, but that's what goes on. And then you get to the adjusted trial balance. After you've done all these things, you make sure everything now does match, and once it does, you can prepare the financial statements, which are the balance sheet, income statement, and the cash flow statement, and various other statements possibly. You derive them from the GL after the GL has been subjected to these processes. And then you close accounts. Close accounts in a way could have been before number 7, because that means what I mentioned with the nominal accounts, and you've really already done that before you can say that the GL balances. You have to have transferred those balances to the GL. But if this just means they're reset to 0 for the next period, then that's fine. So that's the accounting cycle. If you've ever been around accountants and this kind of application, you know that as soon as an accounting period ends, which usually means month end, quarter end, and year end isn't always 12/31, depending on their fiscal year, there'll be a huge flurry of activity to go through these steps. And the bigger the period included, obviously, the more data has to be digested and the more possibility of error there is that has to be resolved. And you don't just have as long as you want to get this all set and move on to the next period, because there's all sorts of reporting. People want to know what's the bottom line now and everything. So the few days following the close of an accounting period are usually quite hectic and even hellish for the people who have to be involved in this stuff. So finally, we get to something maybe a little more interesting, some IT related observations that relate to this kind of stuff that you will see in actual systems. The first is that account numbers are usually what we would in the data warehouse world call intelligent keys, meaning that some of these account properties we've mentioned are encoded in the account number. And this is a typical example, very similar to what they had at Moran Towing, for example. I haven't mentioned it before, the idea of a company having subsidiaries, but that's not unusual in larger companies. And usually each one is accounted for individually, and then all of that is rolled up in a process called consolidation. So if there is a subsidiary, you keep each of their sets of accounts separate by encoding it in the account number, like 45 here. And then generally always, because it's so crucial and critical, you will have the type of account encoded into it too, like the fact that it's a liability account or an equity account or an asset account or an expense account. And then the remainder of the number typically is just numbers that give you the breakdown within those categories. And sometimes there's further encoding within that, like into a major categories of expense and then minor categories of expense, for example. Because these are such intelligent keys, from a data warehousing perspective, you can appreciate if there's a merger or acquisition of two entities that have different accounting, and they almost surely have different encodings for their accounting keys. It can be a real nightmare trying to merge that, since you know that at some level they're kind of the same thing. And this is a perfect example of the value of using surrogate keys, not the business key, in that kind of a setting, because then you don't have to have that kind of conflict. You can keep them separate. And it's very common for the account types to be encoded literally as 1 is asset, 2 liability, 3 is equity, which derives directly from the accounting formula. And AdventureWorks kind of does this in its account dimension. Not entirely, but kind of. Here's another one which I slightly alluded to earlier. The typical data warehouse BI application is not concerned with the full gamut of accounting, especially not the assets and liabilities. It's almost always what's of most interest is the profitability, which is revenue minus expense or income minus expense, also known as net income, also known as profit. At least in my experience, most financial reporting applications really are honed in on that. They want to know who made us money, who lost us money, and when, and on which products, et cetera, et cetera. In terms of management information, that often is not what the focus is. Only if you're working on something, an asset tracking kind of an application or something, which we were at Moran, where the assets were tugboats mainly, then you get concerned with some of those other accounts. But there is often this kind of an emphasis, and what you'll find often that because income minus expense equals profit, both numbers may be coming in from the source positive. They would be if they come directly unaltered from the accounting system, as I just said, which doesn't have signs typically. So often what you'll see some smart person did is, I say that tongue in cheek, is they'll multiply the expense ones by -1, either in storing them in the database that way, or the query will do it so that you can then just add income and expense to get the result. And that works, but it's not necessarily a good idea because it doesn't really respect what's really going on in the larger picture. Sometimes even worse, at least that's understandable, but even worse, you sometimes will see the numbers multiplied by -1 based on whether it's a debit or a credit balance. And once you see that, there's absolutely no way to understand anything about anything without knowing these principles, because that's what it derives from. Whether or not it's correct derives from that, and you just can't get anywhere without knowing that. And it's all too common that you see these kinds of things, and I think that they're often not done with full understanding of what's going on or what their limitations are. But forewarned can be forearmed. Lastly, I wanted to just point out that in the olden days, which is pre-data warehousing days, the GL was typically the only point of integration among all the operational systems because they all had to feed it financial data so that you could do your financial reporting. But there was no other point of integration among all the systems, no common viewpoint across them that would give you an enterprise-wide view of things. And because of this, the GL came to often be, it's really the only source of enterprise-wide reporting that was possible. And because of that, it often got corrupted to support really reporting purposes, often at a ridiculously low level of detail, rather than doing what an accounting system should do. And you can see a symptom of this if you see not a few dozen to 100 maybe accounts, but thousands of accounts, because people open accounts and then they have to convolute the load of the GL to keep these. They're like shadow accounts that get populated according to business rules while the main balance sheet accounts are populated so that you can then run reports off them. When I was at that French investment bank, it was unbelievable. They had accounts in the GL that were down to the level of customer so that they could keep track of profitability for their larger customers. And that is just so bad. But it used to happen. I think today, though, with the advent of data warehousing, has kind of taken the place of the GL as the point of integration and is much more general purpose. So one doesn't see this as much as I used to see it. Here's another placeholder. If there's time, I wanted to talk more about what's behind equity because I don't think that's at all well understood, but I don't have that yet. Nonetheless, I thought it would be fun just to show that this actually does have some possible interest even outside of work. I thought I'd compare shareholder equity for some big well-known companies, which I scraped off the internet. What this means or whether it means anything could be a long discussion, but I thought this comparison is interesting. Here we see that Microsoft, for example, in the 2000s, had very substantial shareholder equity built up upwards of $80 billion, and at the same time Amazon had negative equity, which essentially means it was running at a loss and would have been out of business if it wasn't getting more and more capital pumped into it from somewhere, which happened since it didn't go bankrupt. I think it's fairly common knowledge Amazon has operated at a loss for most of its life. I think it's finally just relatively recently is actually running a profit, but considering its scale, it's amazing how thin the profit margin is. And also, it's interesting to look at the absolute scale of these two. Microsoft is now, as 2014, has got almost $90 billion in equity, while Amazon, although it's very respectively shot up and since 2008, look at where it's at. It's about 11 billion. That's a pretty significant difference. Now, what that difference means or whether it means anything is certainly open to discussion, but it's interesting to see these things. Here's a comparison of Google and Apple. Here you see that Google, for most of its life, had essentially no shareholder equity, which meant if you bought their shares, you really didn't own anything. You were, I like to say, you were pretty much speculating on the greater fool theory that the price would go up and you'd be able to sell it at a profit. But if you call that an investment, that's not really what I would call an investment, because if that doesn't happen, you're left with nothing. And it's interesting to see that Apple also was really low comparatively to Microsoft for all those years. But now it's shot up so fantastically. They're up like 130 billion in shareholder equity in 2013, far surpassing Microsoft. Again, this is neither good nor bad nor indifferent, but once you understand more about what's behind these things perhaps become more interesting than they might have been otherwise. And that finally brings us to analysis services. So here we are in SQL Server Management Studio. I've got the AdventureWorks DW 2008 database and cube running, and we're looking at the account dimension for both of them because AdventureWorks does, it's pretty simplified and limited, but it's very handy. It's there to play with to get a feel for this kind of data more. So it's got an account dimension, which we're looking at SQL-wise. It's a parent-child dimension, which makes sense because The hierarchies that are in a chart of accounts are essentially recursive and don't have any predefined depth. So parent-child representation is the perfect thing for it. And here we start to see terms that you might recognize some of these, especially account type, from the earlier discussion. It's pretty hard to visualize a parent-child dimension, though, in its relational representation, and that's where a cube really shines, because if we look at the equivalent in the cube, the account dimension, and we're looking at the accounts hierarchy here, which is what this little thingy is here, this lets us browse the hierarchy in a very intuitive, obvious, graphical way, and it interprets the parent-childness for us. So I can drill down, and we see balance sheet and net income. These essentially are equivalent to the balance sheet and income statement that I mentioned before. And as you drill down on them, you'll start to see the same kinds of categories that I spoke of. And I'm going to ignore statistical accounts. What I really wanted to point out is that we see numbers here and we can't see it exactly directly, but we know from the accounting equation that there's arithmetic there, assets equals liabilities plus shareholders' equity. But we saw that flowing into shareholders' equity, those four components at the bottom, common stock minus dividends plus revenue minus expense, there's more arithmetic there, pluses and minuses, that has to be applied properly for these sums to come out properly. And this is what's cool, and I wanted to show. This is what's kind of built into it. If we go back and look at the table, the relational version, it's got this column called operator, which has been populated with a character that basically means how should I be aggregated to my parent when I'm doing aggregation. And the choices are plus, which means be added, minus, which means be subtracted, and tilde, which means do nothing. If the nature of it is such that it shouldn't be rolled up to the next level, essentially, you can express that too. So obviously somebody has to set this data up correctly, including these signs. But once that's done, analysis services, after you can appropriately configure this dimension, is able to interpret those and automatically applies them. So when you do these roll-ups, it's automatically adding and subtracting things to get the relevant totals. You don't have to write any MDX or do anything. It just works. So I think that's pretty cool. I don't know whether it has any applicability beyond this kind of bookkeeping stuff, but certainly for that, it's a good thing to know about because it makes it so easy. And it's much more fluid than if you try to do the same thing directly from the relational data in a report. You could do it, but having to yourself navigate the recursive hierarchy and apply the plus minus or nothing stuff, it's very cumbersome in SQL. Not impossible, but very cumbersome. So that brings me to the end. I had hoped to leave you with a long list of handy resources of URLs and books about this, but I found that there's so much good information on the internet today about this, just from Googling any term you want that I've mentioned, or even just accounting or bookkeeping. It's unbelievable what is out there, and in my view, it's all good. Pretty much everything I saw was good information. There's different flavors that appeal to different learning styles, perhaps. But I just decided it was pointless to pick out a few of the URLs that I happen to have looked at and say they're particularly good. They're not. And my bookkeeping books are so old that they're long out of print, so I can't allude to them. But again, it doesn't matter that they're out of print because it doesn't change. So my parting piece of advice is, as developers, is if you have an opportunity to get on a project that involves interfacing, either consuming from or feeding the accounting system, and you want to know more about this and understand it more intuitively or implicitly, you should jump at such projects, because that's, as with everything, that's the best way to learn. So thank you for attending. Bye, everyone.